There's a deadline buried inside every traditional IRA and every 401k in America. Not a penalty you can see coming. Not a bill you get a warning about. A deadline that exists by default, that activates automatically the year you turn 73, and that carries a 25% tax penalty on every single dollar you fail to withdraw on time. And the trap is not the deadline itself. The trap is the decision that comes the year before the deadline. The decision that looks like wisdom. The decision that looks like smart planning. The decision that nearly every retiree in America makes for exactly the wrong reasons. The decision to wait. In the next 20 minutes, I'm going to show you exactly what this deadline is, exactly how the penalty works, exactly why the most natural and most common decision retirees make about their IRA creates a tax consequence that costs them thousands of dollars in a single calendar year, and exactly what to do instead. I'm also going to walk you through 3 moves that can reduce your required distributions, reduce the tax you pay on them, and in some cases redirect a portion of them to charity so cleanly that the IRS never counts the money as income at all. But first, I want to tell you about a client of mine. I'm going to call him Raymond. Raymond is 74 years old. He lives outside of Nashville, Tennessee. He spent 35 years as a regional manager for a commercial insurance company. He retired at 71. He has a traditional IRA worth approximately $420,000. He has a pension from the insurance company that pays him over $800 a month. He collects Social Security. He owns his home. He is, by any reasonable measure, a financially comfortable and financially careful man. Raymond called me in February of last year in a state of genuine distress. He had turned 73 the previous year. He knew that a rule existed about withdrawals from his IRA starting at a certain age. He had heard the number 72 for years, then he heard it had changed to 73, and somewhere in the middle of that confusion, he made a decision that seemed completely reasonable at the time. He decided to delay his first required withdrawal until the absolute last possible moment. He had read somewhere that you were allowed to wait until April 1st of the year after you turned 73 to take your first distribution. He read that correctly. That rule is real. What Raymond did not read, or did not see, or was never clearly explained to him, was the sentence that comes right after that rule. If you delay your first required minimum distribution until April 1st of the following year, you must still take your second required minimum distribution by December 31st of that same year. Raymond took his first required distribution in March. He thought he was done for the year. He was not. He owed a second distribution by December 31st of the same calendar year. He missed it. He discovered the error when he sat down to file his taxes, and his software flagged the problem. The amount he failed to withdraw was $1,400. The penalty was 25% of that amount. That is $4,600 in a single tax year, on a mistake that had nothing to do with trying to cheat the IRS or hide income or do anything remotely improper. Raymond was a careful man who read the rule and missed the sentence that came after it. Nobody told Raymond about the second distribution. Not the IRA custodian, not the brokerage, not the Social Security Administration, not any government letter. The rule exists in the tax code. Raymond was expected to know it. When he did not, the penalty was automatic. My name is Marcus Graves. I'm an enrolled agent, federally licensed to represent taxpayers directly in front of the Internal Revenue Service. I sit across the table from the IRS on behalf of real clients. And the pattern I see that makes me the angriest is not the complicated mistake. It is the simple one. The one that costs a careful, honest, hardworking retiree thousands of dollars because nobody ever sat down and explained the full rule clearly, all the way through, including the part that comes after the part everyone already knows. That is what this video is here to do. Let me start from the beginning, because the rule is actually not complicated when you see the whole picture at once. A traditional IRA and a traditional 401k are tax-deferred accounts. You contributed money before taxes were taken out. The money grew without being taxed each year. The IRS agreed to that arrangement with one condition. You cannot leave the money in the account forever. At a certain age, you must begin withdrawing minimum amounts every year. Those withdrawals get added to your income and taxed. That is how the government eventually collects on the deal. That mandatory annual withdrawal is called a required minimum distribution. Most people have heard the term. Almost nobody has been told the full set of rules around it. Here is the rule as it stands in 2026. If you were born between 1951 and 1959, your required minimum distributions begin at age 73. If you were born in 1960 or later, the age is 75. The rule applies to traditional IRAs, SEPA IRAs, simple IRAs, traditional 401k plans, 403b plans, and most other employer-sponsored retirement accounts. It does not apply to Roth IRAs during the original owner's lifetime. That distinction matters enormously, and I will come back to it. The amount you must withdraw each year is calculated by taking your account balance as of December 31st of the prior year. and dividing it by a life expectancy factor from an IRS table. The table assigns a different factor to each age. At 73, the factor is 26.5. At 75, it is 24.6. At 80, it is 20. The older you get, the smaller the factor, which means the larger the percentage of your account you must withdraw each year. A retiree with a $500,000 IRA at age 73 must withdraw at least $18,168 that year. The same retiree at age 80 with the same balance must withdraw at least $25,000. The distributions grow as a percentage of the account over time. The IRS is making sure the money comes out. If you fail to take your full required minimum distribution by the deadline, the penalty is 25% of the amount you should have taken, but did not. That penalty drops to 10% if you correct the mistake within 2 years by withdrawing the missed amount and filing IRS Form 5329. But even the reduced penalty is real money, and paying it, at any rate, is paying the IRS for a mistake you never had to make. Now let me explain the 2 distribution year trap in detail, because this is the one that caught Raymond and that catches thousands of retirees every single year. The law allows you to delay your very first required minimum distribution. Instead of taking it by December 31st of the year you turn 73, you can wait until April 1st of the following year. That grace period exists specifically to give new RMD recipients more time to plan, but the grace period does not eliminate the second distribution. It only delays the first one, which means if you use the grace period, you take your first distribution sometime between January 1st and April 1st of the year you turn 74, and then you must take your second distribution by December 31st of that same year. 2 distributions, 1 calendar year, both fully taxable. That double distribution year is the trap. And the reason it is a trap is not that the rule is hidden. It is that the rule sounds, at first reading, like permission to skip a year. You read that you can wait until April 1st, and your brain hears you have an extra year. You do not have an extra year. You have an extra 3 months before the first one, and then you owe the second one at the end of the same calendar year as the first. For Raymond, that double distribution year pushed his taxable income significantly higher than it would have been if he had simply taken his first distribution in the normal calendar year. His pension, his Social Security, and his IRA distribution already put him at the upper Social Security taxation threshold. Adding a second full distribution on top of that in the same year pushed more of his Social Security into taxable territory, bumped him into a higher marginal tax bracket, and triggered the first tier of the Medicare RMA surcharge 2 years later. One missed sentence in one rule created a cascade of consequences across 3 separate areas of his retirement finances. Now let me talk about who this hits hardest, because both groups of retirees watching this have skin in this game, and I want to be specific about each one. If you are a lower income retiree with a modest IRA balance, your required distributions may be small enough that missing 1 year's distribution results in a penalty in the hundreds of dollars rather than the thousands, but the tax cascade still applies. Any double distribution year still pushes your provisional income higher, still affects your Social Security taxation, still has downstream effects on your Medicare premium. The scale is smaller. The principle is identical. If you are a comfortable retiree with a meaningful IRA balance built up over 30 or 40 years of consistent contributions, the stakes are considerably higher. A $400,000 IRA generates a first-year required distribution of roughly $15,000. A $700,000 IRA generates one closer to $26,000. Missing a distribution at those levels means a penalty measured in thousands of dollars. And the double distribution year, if you trigger it by using the April 1st delay option without understanding the second distribution requirement, can push your taxable income into territory with real tax consequences. Both groups need to understand this rule. Both groups have moves available, and I am going to give you both sets of moves right now. The most important move for every retiree approaching age 73 is simple to state and almost never actually done. Take your first required minimum distribution in the calendar year you turn 73. Do not wait until April 1st of the following year unless you have a specific documented reason to believe the delay benefits you after fully accounting for the double distribution requirement. For the overwhelming majority of retirees, using the grace period creates more problems than it solves. Take the first distribution on time, 1 distribution per year, every year, by December 31st. That is the baseline. The second move is to automate the distribution. Every major IRA custodian, every brokerage, every bank that holds an IRA offers an automatic required minimum distribution service. You set it up once. The custodian calculates your distribution amount each year based on your December 31st balance and your age. They send you the check or deposit it into your bank account by a date you choose. You never have to remember the deadline. You never have to calculate the amount. You never have to worry about missing it. The service is free at virtually every institution, and I have never once met a retiree who regretted setting it up. I have met dozens who wished they had set it up before the year they forgot. The third move is to consolidate your IRA accounts before distributions begin. Many retirees have multiple traditional IRAs at different institutions. An old IRA from a job in the 90s, a rollover from a 401k at a company they left 15 years ago, a new IRA they opened separately. Each account has its own required minimum distribution. The total RMD can be satisfied by withdrawing from one or some of the accounts rather than all of them, as long as the total amount withdrawn equals the combined required amount. But calculating the combined requirement across multiple accounts at multiple institutions is where errors happen. Consolidating into one or two accounts before age 73 simplifies the calculation, simplifies the automation, and dramatically reduces the risk of a missed or underfunded distribution. Now, I want to give you 3 bonus moves that go beyond simply avoiding the penalty, because avoiding the penalty is the floor. Managing your required distributions intelligently is the ceiling, and the difference between the floor and the ceiling over a 20-year retirement is often measured in tens of thousands of dollars. The first bonus move is the qualified charitable distribution. I have mentioned this in previous videos, and I will keep mentioning it because it is the most underused tool in retirement tax planning. Once you're 70 and a half years old, you can direct money from your IRA directly to a qualifying charity, up to $111,000 per person in 2026. That distribution counts toward your required minimum distribution for the year, and the money is completely excluded from your taxable income, not deducted, excluded. It never appears in your adjusted gross income at all. Think about what that means in practical terms. A retiree who must take a $20,000 required distribution and gives $10,000 a year to church can route that $10,000 directly from their IRA to their church, satisfy half their required distribution, and pay zero income tax on that $10,000. The other $10,000, their distribution, is still taxable normally, but half of their required distribution effectively vanished from the tax calculation entirely. For a retiree in the 22% tax bracket, a $10,000 qualified charitable distribution saves $2,200 in federal income tax, compared to taking the full distribution as income and then writing a separate check to the church every year, for as long as they continue giving and continue having IRA balances. Most retirees who give to charity are writing checks from bank accounts, getting no tax benefit because they take the standard deduction and paying full income tax on their entire required distribution. The qualified charitable distribution eliminates that inefficiency completely, and it is available to any retiree who is 70 and a half or older, gives to charity in any amount, and has money in a traditional IRA. The second bonus move is Roth conversion. Before required, distributions begin. Once required, minimum distributions start. You are required to take them. You cannot choose not to take them. You cannot put them into a Roth IRA. You cannot defer them further. The money comes out and gets taxed. That is the deal. But in the years between retirement and the year you turn 73, you have a window. In that window, you are not yet required to take distributions. Your income is often at its lowest point in your adult life. Your tax bracket may be lower than it has ever been, and you can choose, voluntarily, to convert a portion of your traditional IRA to a Roth IRA each year. The conversion is taxable in the year it happens. That is the cost. But once the money is in the Roth IRA, it grows tax-free forever. It is not subject to required minimum distributions during your lifetime. And when your required distributions from the remaining traditional IRA begin, they are calculated on a smaller balance because you moved a portion of it out during the conversion years. A retiree who converts $30,000 to $50,000 per year for 5 or 6 years before age 73 can dramatically reduce the required distributions they face in their 70s and 80s. They pay the tax now at the lower bracket, instead of paying it later at a potentially higher bracket on a larger mandatory amount. And the portion they converted grows and distributes completely tax-free for the rest of their life. The third bonus move is for the retiree who has inherited an IRA in the last few years, because the rules for inherited IRAs changed dramatically in 2020, and the consequences of getting it wrong are just as severe as getting your own distribution wrong. Before 2020, when you inherited an IRA from a parent or a spouse, you could stretch the distributions over your own life expectancy. A 50-year-old who inherited an IRA could take small distributions for 35 years, letting most of the money grow tax-free in the meantime. That rule is gone for most beneficiaries. Under current law, most non-spouse beneficiaries who inherit a traditional IRA from someone who died after December 31st of 2019 must withdraw the entire account within 10 years. The 10-year rule. All the money fully taxed within 10 years. And here is the part that surprises almost every beneficiary I work with. The IRS issued final guidance in 2024 clarifying that for inherited IRAs from owners who had already begun taking their own required distributions, the beneficiary must take annual distributions throughout the 10-year period, not just empty the account by the end of year 10. That means if you inherited an IRA in 2021 from a parent who was already 73 or older and taking their own required distributions, you may have been required to take annual distributions in 2022, 2023, 2024, and 2025. If you did not, you may have missed required distributions for multiple years. The penalty for each missed year is 25% of the amount you should have taken. On a meaningful inherited IRA balance, that is a significant number multiplied across several years. The IRS waived penalties for missed inherited IRA distributions in 2021 through 2024 while the guidance was being finalized. But that waiver is over. Beginning with the 2025 distribution year, the penalties apply. If you inherited an IRA in the last 5 years and you have not been taking annual distributions from it, you need to look at the situation immediately and consult someone who understands the current inherited IRA rules. This is one of the situations where getting professional guidance is not optional. The consequences of continuing to miss distributions are real, and they compound with each passing year. Let me tell you what happened with Raymond after we worked through his situation. The missed distribution penalty was $4,600. We filed Form 5329 with a letter of explanation and requested penalty abatement. The IRS reduced the penalty to 10%, which was $1,840, because we filed within the 2-year correction window. Raymond still paid almost $2,000 for a mistake that came from reading one rule and missing the sentence that followed it. After we resolved the penalty, we set up automatic distributions from his IRA for every subsequent year. We calculated the exact amount needed each year based on his December 31st balance and the IRS table factor for his age. We scheduled the distribution to hit his bank account every November 15th, giving him 6 weeks of buffer before the December 31st deadline in case anything went wrong. We also looked at his charitable giving. Raymond gives $7,500 a year to his church. We converted that giving to a qualified charitable distribution from his IRA. That $7,500 now satisfies a portion of his annual required distribution and is completely excluded from his taxable income. At his 22% marginal rate, that is $1,650 a year. He is no longer paying in federal taxes on that portion of the distribution. Over 10 years, that single change saves Raymond $1,650 from one conversation about one rule that his church, his brokerage, his pension administrator, and every other institution in his financial life had never thought to explain to him. Nobody told Raymond. That is the pattern. And that is the reason this channel exists. Let me leave you with the one idea that ties everything together because it is more important than any single rule I covered today. Your IRA is not a savings account. It is a tax-deferred contract with the federal government. The terms of that contract include mandatory withdrawals at a mandatory age, on a mandatory schedule with a mandatory penalty for missing the deadline. Those terms are not negotiable. They are not flexible. They do not bend for honest mistakes, for confusion about the rules, or for the fact that nobody ever explained the contract clearly when you signed up. The government does not call you when your first required distribution year arrives. Your IRA custodian may send a notice. Many retirees miss it. The IRS does not send a reminder before the December 31st deadline. It sends a penalty notice after. Understanding the contract before the deadline is the entire difference between Raymond with a $4,600 penalty and Raymond with zero penalty, with automated distributions running, with a qualified charitable distribution strategy saving him more than $1,500 a year, and with a Roth conversion plan that will reduce his required distributions and his tax bill for the rest of his life. One video, 1 hour of planning, thousands of dollars in difference. Before I wrap up, I want to give you something to take with you. I have put together a free checklist, my 2026 Retirement Tax Protection Checklist. It covers the full required minimum distribution rules by age and account type, the automated distribution setup instructions for every major IRA custodian, the qualified charitable distribution rules, and the step-by-step process for redirecting your giving from your bank account to your IRA, the Roth conversion window strategy and the income thresholds to watch, and the complete inherited IRA 10-year rule with the annual distribution requirements that apply under the 2024 final guidance. Every item on the checklist includes the form number, the deadline, and exactly what action to take. To get the checklist, go to marcusgravestacks.com/checklist. The link is also in the description, printed out before the end of this year, because the decisions you make before December 31st are the ones that protect you from the trap. And the decisions you make after December 31st are the ones you make while writing a check to the IRS. Here is what I want to leave you with. The 25% penalty exists because Congress wanted retirees to take their distributions, not because Congress wanted to punish honest people, but the penalty does not distinguish between the honest retiree who missed a sentence in a complex rule and the one who deliberately tried to avoid the requirement. It applies equally, automatically, without a letter asking you to explain yourself first. Raymond was a careful man. He read the rule. He missed the sentence. He paid $40 after the penalty was reduced. And then he spent the next 30 minutes in my office saying the same thing I hear over and over again. Why did nobody just tell me the whole thing? Send this video to one person you know who is in their late 60s or early 70s and has money in a traditional IRA or a 401k. The required beginning date may be closer than they realize. The rule is not complicated once you see the full picture. And one share from you today could be worth thousands of dollars to someone who is about to walk into a deadline they do not know is coming. That is what this channel is here to do. I will see you in the next one.